I think one of the things that a lot of people love about you, like I just watched your last video. I love them when you're sitting in your backyard or even your car ones. And I
Yeah,
think people love about that is that it makes you so genuine. Like you're just a real
yeah.
person. And when I read the title of that video, I was like, uh-oh, what's going to
Uh-oh.
happen here? But it was good. It was you just talking like a real person about something you're passionate about.
Yeah, yeah. And I didn't post that one on Blossom because I thought maybe that would ruffle too many feathers. So even though it would probably get me more views, but I didn't bother sharing it on Blossom. Not yet anyways, maybe I will.
Hey, everybody, I'm here with Paul from Better Call Paul. Now, we're both 52, we're both Canadians, and we're both sitting on portfolios just around $420,000 at the time of shooting this video. But the way that we manage them couldn't be any more different. Paul's gone all in one on the covered call ETFs, and he's actually living off of the income right now. He's testing whether it can cover his expenses. Now, I'm still in the growth mode and I'm adding capital regularly with about 12% of my portfolio in covered calls for a bit of balance. Now, Paul and I connected on Blossom Social, where the growth versus income debate is an extremely hot topic. So we thought, why not talk it out together, podcast style, and maybe turn this into a reoccurring series? Okay, Paul, let's start with what you're doing right now. You've been pretty open about your case study, living off of your portfolio after losing your job, which, by the way, I'm really sorry to hear about that. Now, there's no new contributions to your portfolio. You're withdrawing monthly income. Can you walk me through how that's working so far?
Yeah, Darren, thanks for inviting me on your show. I'm really happy to be here and talk to you about this. I mean, there has been a little bit of an overlap because I did stop working September 1st, but I got my last paycheck and then I got my vacation pay. So I've had enough funds from my old job to kind of carry me through, I guess, the month of September and, for probably the next week or so. But for about 2 years now, I haven't been contributing anything to my portfolio, like on a regular basis. That's what I used to do. I used to have a financial planner and, we just automatically every month, a certain amount of money would get sent over to them and they would invest it for me. But yeah, for the last 2 or 3 years, I stopped contributing to my portfolio with a couple of exceptions, which we can talk about if you want. But, and then uh, back in May, I decided to come up with my case study where I was withdrawing $1,000 a month. And I was working at the time, so I didn't really necessarily need the money, but it allowed me to put a little bit more aside for vacations and it allowed me to just kind of go out and spend a little bit more recklessly that I probably wouldn't have otherwise. So, because I had the extra money. But so far, it's going really well. I mean, I know we're in a bull market, everybody's green, everybody's up, but the fact that I'm pulling money out and I'm not putting any money in, and my portfolio is at all-time highs. I think I hit about 436 this week. So it's been good. I'm assuming it's gonna drop. You know what I mean? That's what I'm kind of mentally prepared for is the upcoming correction. I think it's gonna be
Yeah,
short though. That's my opinion. I think it's gonna be a
yeah,
short correction.
it's good that you brought that up because it's one of the questions that I had posed a little bit later in this interview. But I think a lot of people are really wondering, and myself included. I have about 52,000 in them. And yeah, I'm wondering the same thing. I think history tells us a lot. If you do a little bit of research about the markets and understand how they go, there's ups and downs. And in your last video, you mentioned dollar cost averaging. Can you touch on that and how important it is to investors no matter what they're investing in?
Yeah, well, it's really important, right? I mean, even if you look at the greatest investors like Warren Buffett, they talk about buying stocks at a fair price, right? Like a good business, but at a fair price. They don't talk about buying them at all-time highs, right? You want, I guess it's what value investing, where you want to buy something when it's low and and then, ride the wave up. But the same thing can be done with covered call ETFs. I was looking the other day at HHIS, for example, and it had dropped down to just over $8 a share. So if you had started buying and loading up at that price and now it's over $13 a share, you can do really well. And also if you happen to be in a position where like when I first bought HYLD, I think it came out at 15 or $16 a share, it dropped down to 10 bucks a share. So at that point, everybody was laughing at us. You covered call income guys are dumb. Look how much money you've lost. Well, we just kept buying, right? I just kept buying and buying and buying until my average cost for HYLD was around, I think, $13 a share. and now it's over 14. So now I'm in the green capital wise, not to mention 3 years worth of dividends. So if you understand how they work, you can make money from them.
Well, and your income is going to stay consistent, even though the stock price might drop. I think that's the big thing. And that's the psychological piece, I think.
Yeah. Yeah, and for me, it's grown. Like the income has grown at a pace that I don't think I could have ever imagined.
Yeah. Now, what made you decide to go all in one on covered calls instead of sticking sort of mix of growth and income like I'm doing right now?
I think I'm impatient, to be honest with you. I think I just don't have the patience. Like maybe a couple years ago, I was buying VFV when it was around $90. And, you get that. I don't know what it is, a 0.5% or a 1% dividend every 4 months. And it grows a little bit, but I look at it and then I look at, okay, if I sell this and buy this, I can start making, X number of dollars right away every month. And for me, I guess I don't have the patience for the long-term growth investing.
Right. And I guess that would go to the same idea that in a growth investing portfolio, if you want that income, you're going to have to sell some of your shares in order to achieve sort of more income outside of the dividends because the growth is locked up in the stock price. Fair statement?
Yes, correct. And you know what? And I'm not saying that's a bad strategy at all. Like I know people have mathematically worked it all out and you can have a portfolio of growth, you can sell your own shares, you can create your own dividends, and that's a fine strategy if that's the one you want to use. It's when you think about it, it's kind of like hockey or football where different coaches have different mentalities and different strategies. And this is just the one that in my mind it works. So it works for me.
How do you manage the mental side of this? That you've gone from a regular paycheck to relying on market income, although you did say you do have some income. What's that shift like? Is it stressful, freeing? Like, how do you feel about that now?
Well, to be honest with you, like having been so focused on income for the last 2 or 3 years, I kind of knew that this moment was coming, right? I didn't know when it was coming, but I knew it was coming. And about a year ago, when my income hit 5,000 a month, it was almost like a sigh of relief that now I could quit my job and I would be okay. I wouldn't be rich, I wouldn't be, driving a fancy car or anything, but I'd survive. And then once you go from there to 10,000 a month, now it's like, well, now I'll be really okay. So when they told me that I was losing my job, it was like, oh, thank God, I don't have to drive to Scarborough anymore. It's an hour and a half commute one way and an hour commute home. And just the drive alone was stressful.
Yeah, I can appreciate that. Up until 2 years ago when I started my journey, we didn't have very much at all. And I can now, at this point, having seen my portfolio grow, using the strategy that I'm using, I can tell you that I feel the same way now. It's like, oh, if something happens, I know that I can rely on the income. And I think you've proven, even if you're not going to be a millionaire, that this does work to keep you psychologically good when it comes to your finances and know that you can rely on that money.
Yeah. Oh, for sure. And it's nice to know that the money's there and the money's coming in. And of course, there's going to be periods where the market could go through, say, a bear market or a recession, and all of our portfolios are going to drop. And it's possible that a lot of these companies are going to end up reducing their distributions. But that's the smart thing to do because otherwise they're just giving you back the bad rock, which we don't want, right?
That's
And
right.
the other thing is that if we are going through tough times, I can always alter my lifestyle, right? I don't have to go out with friends and spend $100 on chicken wings and beer, if I'm not bringing in the money that I can sustain that, that sort of lifestyle. Or maybe instead of 3 or 4 vacations, we only go on one, right?
Yeah.
Until things get better again, So, and again, of course, dollar cost average. Buy low, buy when things are
I think
low.
that I think that's a great point. Just this morning, I when I wake up in the morning, I like to jump on Blossom. There's, more and more new investors coming on like I did a couple of years ago, and they're always asking the same question. It's a very good question. What do I do? And these
Yeah.
points that you're making apply, and I mentioned it this morning in the post that I made, is it doesn't matter what strategy you take, you have to look at some basic things, and you're hitting on one of the ones that's really important, and that's how you manage your finances. Yeah, we're not here to get rich. I mean, I'd love to be Warren Buffett. I'm sure
Of
you would,
course.
but
Yeah.
we're not going to be those guys. But what we are going to do is we're going to build our wealth and feel more comfortable with the money that we have. And as we learn more, you can employ some of those strategies. When I started, no idea what I was doing. Did you feel that way?
I guess in a way I did. Like when I first started going from mutual funds into managing my own portfolio, I did like when I was younger, I read The Wealthy Barber. I read the what is it, The Millionaire Next Door. Like I read 4 or 5 different investing. I think I read a Warren Buffett book back, when I was in my 20s or something. So I had a little bit of knowledge and I knew that I wanted to get into things like bank stocks, right? I knew there was things like bank stocks that you could buy that were, safe and would pay a dividend and everything. And then I just started doing research, right? I just started reading Motley Fool articles and going on YouTube and just keep learning more and more and more. And I've tried a lot of different things. Like I haven't just used covered call ETFs. I've had some real disasters. I've lost 100% of quite a few investments. So when people think that covered calls are dangerous, no, not even
Yeah,
close.
yeah, I think that brings me to a couple other important things. Is like for me, and I guess it sound like because again we have a lot of similarities and where we are in life. And for me, I'm a busy guy, so I don't necessarily have a lot of time to figure out what's the next Google, what's the next Amazon stock. So ETFs work well no matter what they're investing in. And then what is it about? Well, you mentioned that you've had, some things that haven't gone really well, and you mentioned earlier that you would be willing to talk about it. So, well, I think a lot
Sure.
of people see you on Blossom and your channel. Which, by the way, guys, if you haven't checked it out, check out his channel. It's Better Call Paul. It's growing quite quickly. Lots of great conversation there. So make sure you check that out. But what are these other investments, Paul, that you're referring to?
So some of the ones off the top of my head, back if you remember back when the pot stocks were very popular, there was one not too far from where I live called Alethea out of Grimsby. So maybe I put $400 into it. Like I didn't put a lot of money into it, but it got delisted, so I lost 100% of that, right? And I don't have a covered call ETF where I've lost 100%. And even the ones that are down, like TSLY, right? Even the ones that are down, they still pay me every month. So I'm still getting something back from them, whereas that one went to zero. I think I was in Bed Bath and Beyond (BBBY) when it became a meme stock, right? That one got delisted.
Right.
I think you're into REITs.
I have some REITs. Yeah.
Yeah, I had some REITs and I bought some after 2020, so they were good recovery plays because they were really low at the time and they went up. And luckily, I started selling quite a few of them off right before the interest rate hikes, so I
Right.
didn't get killed on that. But I kept Innovalis. I don't know if you ever heard of Innovalis, INOUN.
No, I haven't heard
I
of that one.
was I was in around $9 a share, and I think it dropped to about 80 cents.
Wow.
Yeah, so I lost maybe 5,000, maybe $6,000 on that one REIT.
That's quite significant. I can say that I haven't had that, but with my REITs, what I do notice is like Plaza REIT is one. It's a Canadian REIT. It's a sort of a smaller version of our REI.
Yeah,
They're a commercial business, and I've owned it for the entire time I've been investing since 2023. And like you said, as interest rates and the economy changes, so does the stock price. Pretty steady Eddie,
yeah.
almost is what I'd describe it as. And I've thought a lot about getting rid of it. My original investment into it, the stock price was super low. So when I first started, I was like, it's like $3 or $4. So if I got
Yeah.
$3 or $4 kicking around, I'll throw it in. But now, with Wealthsimple and other brokers allowing for fractional trades, there's really no need for that anymore. Which, by the way, folks, that's also an important thing. Picking a broker. Can you talk about the brokers that you use, Paul, and why you chose them, maybe?
Well, yeah. So when I first decided, when the market crashed in 2020, and I finally made the decision that, like, if I was ever going to invest in stocks, now would be the time to do it, because a lot of the bank stocks, TD Bank went from whatever, 90, $100 a share down to like 50. I thought, okay, this is a price I can afford. And I was banking with RBC. So I just went online, tried to set up an RBC direct account. I think a lot of people were doing it because it took weeks. It took a few weeks. Although I have come to learn that RBC is not the best for doing things. So that's another story. Once I got on YouTube and started watching videos, started seeing people posting about Wealthsimple, I decided that's the way I wanted to go because of the no fee transactions. And I mean, to be honest, back in 2020, Wealthsimple was not very good, but I've noticed that every 3 to 6 months they upgrade, right? They're always adding something new, and I think it's become a really good broker now.
Yeah, so I started the same way. I didn't really know. I was with TD, and that didn't go very well. I did make a few videos on why it didn't go very well, but it's interesting because when I read on Blossom, which, by the way, folks, you can also check out. Both Paul and I are on there. Look us up. It's a great place to bring the puzzle together, is the way I like to describe it. If you're
Yeah.
asking questions and you're not sure, you're gonna be able to go there and have some conversations and probably learn some stuff. You can do lots of searching, and they're also a Canadian homegrown business, which is also kind of nice if you want to, invest in something like that. You can do it free, or they do have a paid version if you're interested in that. You can check out both Paul and I's YouTube sites. There will probably be links in those descriptions about those. Um, so I started with TD, didn't go well, like $10 a trade, I think back then, and then I found
Yeah.
Wealthsimple as well. The thing that I love about Wealthsimple is they're actually a financial institution, where Questrade, which is the other broker that I use, is not. Now, they will likely compete. They've gone to some fractional trading thus far, although I must admit I don't think it's fast enough. But that's what Wealthsimple's trying to compete with, is some of the bigger banks. And that's why you're seeing lots of products, which I find very interesting. In fact, this morning, they always have rewards. Did you notice that you can put in for a new home?
Yeah, isn't there like a contest or something? Yeah.
Yeah, so they
Yeah.
always have stuff like that, guys, and that's worth checking out if you're looking for, something new. And in this case, they're giving away a house, so that's pretty neat.
I opened up a checking account with them as well. They got checking
Yeah,
accounts, I think credit cards, and I believe they have a US one. So what I'm trying to figure out is, can I just transfer my US dividends into my US Wealthsimple account and not have any conversion,
good
right?
question. These are good things that make us creators want to
Yeah.
do new topics. That's a new one for me. I do have the US for accounts, and I know that you can transfer funds, but I'm not sure about dividends because they would be cash. You know what? I'll research that one and we'll try and figure
Yeah.
that one out because that's a great question for people.
I'm going to test it one of these days.
Yeah.
Yeah.
So, Paul, have there been any surprises so far in your journey, the good or the bad, since you started experimenting with these cover calls?
Well, yeah, there's definitely been some bad. Unfortunately, that usually and people who are big fans usually get mad when you say it, but it usually goes back to yield max. They I have to give them credit because they were kind of like the pioneers in the single stock ETF market or whatever you want to call it. But unfortunately, the way they did it, where they were trying to maximize the yield, they allowed their share prices or their NAV to just erode so poorly that if you got in at the right time with certain funds like Misty, and when they were paying $4 a month on a $20 share, you could literally pay off your initial investment in a ridiculously short amount of time. But if you waited and you got in later, or if you happen to be somebody who bought, could you imagine buying it when it was $40 a share and now it's at 13, right? You'd be ready to kill yourself. But
If you guys want to see what that looks like, check out my QQQY video because that's exactly what
mm,
happened to me. And it was, I'm not gonna lie, I was like, oh my God, why is the stock price dropping every day? But now that I've met people like yourself and Adriano from his channel and a lot of PII folks, I've learned a little bit more about sort of the strategy because I think that's the important part to understand. Yes, there is going to be the all important NAV erosion, which leads me to my next question. So a lot of people on Blossom and YouTube say cover call ETFs beat the market because of their yield, but evidence from guys like Ben Felix and others suggests that you can't outperform long term. So how do you square that with your real life experience?
well, so for me personally, my goal is not to outperform. And I find the funny thing is that people will read one of my posts on Blossom or Perry's or Adriano's or whoever's. They'll read the post and then they'll say, well, if you had just bought Palantir instead of PLTE, you could have made 40% instead of 30%. And then you look at that person's portfolio and they don't own Palantir, right? They own like XE. So it's like, well, why are you not holding the underlying stock instead of an ETF? Because there's no way XEQT is outperforming Palantir and Nvidia and all those stocks that have skyrocketed like 800%. But I personally, I don't feel comfortable trying to pick and choose which is going to be the next great stock, when I should buy it. I mean, frankly, for all of those ones that I've listed, you probably missed the boat like 2 years ago, right? You probably
Hmm.
should have been into Nvidia 2 years ago or Palantir or whatever. Like now we're kind of buying it late, if you ask me, right? And even what's her name, Kathy Woods from ARK? I heard she sold Nvidia at like $200 a share, and then it
Right.
ran up to like $800 a share. So if
That's
she
the
doesn't
hard
know how
part
to
of this.
manage these things, how am I
Yeah.
supposed to know, right?
And that's the real truth is I think when we talk about Ben Felix, which by the way, folks, he does have his own YouTube channel. He also is part of the Rational Reminder podcast. So I often recommend that people take all kinds of sources, including Paul's channel and other people, to sort of figure out what works best for them. Does it make it right? No, not necessarily for every investor. And I think Paul and I are good examples of that. We kind of fall in that gray area. 20, we're not 30, and we don't have a huge time horizon. So trying to build things out now, at this stage in our life is what's going to be most important. We've already said that we're not looking to be the next millionaires or whatever. We just want to grow our wealth and manage it appropriately as we learn more. Uh, Now, you got to get a chance to go to the Blossom event in Toronto, correct?
Yes. Yeah. I got to go. It was
Tell us a
great.
little. Tell us a little bit about that. How was that?
Well, it was fantastic. I got invited on the Friday night to go to the Chicago Board of Exchange closing. So that was a little bit more intimate. There was maybe only 40 or 50 people there, but I got to meet Brandon Beavis. I got to meet Max. I got to meet Mark Beavis, Adrian in a t-shirt, or sorry, Canadian in a t-shirt. I got to meet Adrian, right? So that was a lot of fun. And then on the Sunday, going to the Blossom event, it was surreal because, Sean and I arrived. We couldn't even get into the Sky Dome before people started approaching us, and they knew who we were, right? Which was really cool. And, they wanted to take pictures with us, which was, it's like, who am I that you want to take a picture with me? But hey, it was fantastic to just talk to people and have conversations about passive income investing. And then finally to get to meet Adriano and his wife, Erica, who I've been following for 5 years now. And I keep telling my wife, like, we have to fly to Panama to go visit them. And she's like, but you don't know them. And I'm like, oh, but I do, right? But that's the community that we're in, right? We're such a tight knit group. So
Yeah, so I was going to lead to the nav erosion question, but before I did that, I wanted to talk about Blossom. So Ben Felix was he at the Blossom event there?
he is. Ben Felix is like 6'10". He's probably the tallest guy I've ever seen. And there's no doubt that Ben Felix is extremely intelligent. And I think I've been asking a few people, I think if you have a minimum of $2 million, you could hire PWL to manage your money. But where does that leave us?
That's a great point, Paul, because I listened to your last video where you talked about that. And I can tell you from my perspective, in my own experience, I've done almost exactly the same stuff as you mutual funds, trying to use other advisors to do stuff. And they told us the same thing. We brought them like 20 grand or whatever it was, 12 grand, and they didn't want to touch it with a 10-foot pole because
Yeah,
the amounts need to be higher. And you mentioned it in your video. It's all cost based. They make a percentage sometimes on what they give. But
of course.
the reason that I'm mentioning it is that you took the time to go meet with all these other people. You're always willing to engage with others and have a conversation. And I think that's the key to all of this. Did you go to school to learn any of this, Paul?
You know what? I studied general business at Sheridan College in Oakville. I live in Ontario. And as part of general business, we took some financial courses. But again, this was back in 1993, right? And I didn't pursue it as a career. So you're talking about something that I learned in college, a little bit. I kind of understood what short selling was and other things like that. But no, I'm not. I don't have any letters behind my name or any specific education. No.
You're just a regular Canadian, just like
Yeah.
me, who's trying to figure it out, and you're sharing your journey with others. And I know for me, I just want to be able to motivate others. I can't believe that I made it to 50 and didn't know that this was a thing. And had I have started earlier, we'd be different. Does that make me dwell on it? No, not at all. That's why I like doing this, is talking to people like yourself and Mo and other people out there. A Canadian in a T-shirt is another great resource. There's so many other creators out there that kind of offer, their journey and stuff. So let's jump into this. all important nav erosion question that you're probably getting tired of answering, but I think it's an important one because I think your perspective is important. So let's talk about nav erosion, the slow decline in value that we see with some covered call funds. I had it written as many, but I didn't think it was fair to say that because it's only some and not all. So does that concern you, or do you just focus on the monthly cash flow and maybe expand on that a little bit? Because I know you can talk quite a bit about this question.
Yeah, no, to be honest, it doesn't really concern me too much. And I think a lot of it, like I was talking about yield max, a lot of it has to do with how aggressive the fund is. Are they writing options, calls, puts, whatever? Are they writing it on 100% of the portfolio or just a small portion? And I think a lot of the Canadian ones, to be more safe, I guess, on the safer side, they tend to write between 30 and 50%. So you actually have 50% of the underlying stock or index, right, that can run with the market. So you will capture some upside. And to be honest with you, I agree with Adriano. I go with all the ETFs that have the 25% leverage. So I'm willing to capture more of the upside and get a higher distribution, and willing to accept the opposite on the downside, right? You're going to capture more of the downside for sure, but
Yeah, and so
it
like
doesn't bother me.
we've been in a strong bull run in the market for quite some time. At the time of this video, it's 2025. It's October, pardon me, and there is a very good possibility. History tells us that we're going to see a downturn. So that's important to acknowledge, but it's also going to affect even someone like me that has more growth stocks. I see cover calls as a tool, about 12% of my portfolio. So enough for me to have some income, but enough to, not necessarily choke out my growth. Now, and if you watch one of my recent videos, I talked about my wife is going through a similar situation to you where she might not have some income. So I restructured my portfolio to use some of these cover calls to generate this real time income, I'll call it. So I don't have to sell some shares and whatnot. So, what would you say to someone like me who's trying to strike the middle ground or balance, especially at our age? Because that's the audience I think that you and I speak to the most. I think it's like the 45 plus crowd.
Yeah, well, I think that for somebody who is still looking for growth like yourself, then definitely just be a hybrid investor. You know what I mean? And in my opinion, I think it's almost as simple as doing like Mo and buying XEQT. And I also like FEQT because I think it's managed slightly different. I think it's a more actively managed ETF, and it's got something like 3% crypto or 3% Bitcoin, one of the two. So it's a little bit more, I think, aggressive than XEQT. And to be honest with you, those are the two that I'm having my own kids invest in, starting with XEQT, and then we're going to add FEQT soon. 'Cause my kids are in school. Like my son's in university. He doesn't even have a job right now, and he's still able to buy almost $200 a month worth of XEQT because I already built for him an income portfolio. So he has
Right.
an income portfolio that buys him XEQT. So
Yeah.
that's what I think. I think you can do both. Obviously, you can do both, right? And you just need to figure out your balance. Do you want to do 50-50? Do you want to do 60-40? You know, what's the magic number for you? And I think over time you'll probably shift it, right? As you see you want
Yes.
more income.
You mentioned before that your income covers your monthly expenses right now. How sustainable do you think that it is if the markets go sideways or down, like we've already mentioned? What do you think is going to happen when that goes on?
I think for me, it's going to be sustainable because I'm kind of in a similar situation as Perry, where I'm lucky enough that my monthly income from my portfolio is about 2.5 times my expenses. So really, it could drop down quite a bit, and I would still be okay. Wouldn't have as much to reinvest, right? But I think I'll be okay. And so I'm not worried about that. I would like to get it higher though, to be honest with you. Right now my goal is to get to 15,000 a month. So
Right.
yeah, I'm gonna kind of do whatever I have to do to get that to happen.
So let's talk about mindset. So your approach seems very peace of mind focused. Would you say you're more about consistent income than total returns?
Yeah, I guess you could say that like the monthly income is definitely my focus. You know what I mean? And it won't always grow month by month. Like even though you're buying more shares and you're growing your, I guess, your income base, you have the one-offs like MSTE that reduce distribution by 5 cents. And if you've got like 3,000 shares, that's a big chunk that's coming out of your monthly portfolio, right? But at least every 2 or 3 months, I like to see the amount I'm making going up. Now, I I I do, Darren, like I'll be honest with you, like people say that there's nav erosion and that, everything's just going to whittle away and it's I'm on a slow, basically you're on a slow decline. Um, and then you tell them how well you're doing and they're like, well, but it's a bull market. Okay, but you said that when my portfolio dropped, like it did in April, I dropped from December to April, I dropped $96,000. And I can't remember what the percentage is, but I dropped $96,000 from December to April of this year. And then from April till today, I'm up 145,000. So considering that they say, covered call ETFs won't capture, see, they do capture upside. They just don't capture all of the upside. But
That's
right now,
right.
my portfolio is up 105% all time. And as long as it's up like that, and I'm making 10,000 a month, I don't worry about the total returns.
Yeah, no, that's
Yeah.
actually a great point. I mean, I think, again, like you and I are in a very unique part of our life. And I think I'm just guessing here. So if viewers want to drop comments and bash us for this, go ahead. But I think that people like Ben and other people that are consistently saying the same narrative, they're trying to show people if you're 20 and you're starting out, I don't know about you, Paul, but I wouldn't necessarily lean them completely into this because they are going to be leaving some money on the table, as it were.
Yeah.
We're in a very unique position at the end of our lives where, I shouldn't say end of our lives, but we're older. And so I like that. So for me, in that same time frame, my portfolio dropped 30 grand. And in the same period of time, I've captured more of the upside with the growth side. So this is exactly why I wanted us to do this kind of video, because it shows that there are different methodologies and mindsets. So you're okay with that. And I appreciate that. I think that's cool. For me, I'm still adding money. So it doesn't make sense for me just to go all in. And another point is, we kind of hinted at it already, but dollar cost averaging gets those ups and downs. You're going to, instead of picking the stock, but let's take gold, for instance. There's a lot of posts right now on Blossom and around the, so the markets that gold is on fire. Yeah, well, we missed it. That doesn't matter right now.
Exactly.
You should have
Exactly.
been, you should have been in it before, which leads me to my next question then, which isn't a scripted question here, but split share funds. When I started out, Adriano had some split share funds, and I actually sold mine off because but what do you think about those? And I'm referencing the fact that you mentioned the ups and downside, because if I'm not mistaken, they are fairly consistent in what they pay.
Yeah. So when I first started watching Adriano's channel back in 2020, I think it was in June or July, where DFN had finally recovered. Because if you understand how split shares work, there's two sides, right? Um, That's why it's a split, right? So you got two shares, one that's the aggressive one and one that's not. And one's guaranteed income and the other one's not guaranteed. But the two of them combined have to have a NAV, usually of around $15. So DFN had just gotten back to the point where it was going to start paying its 10 cents a month. But at the time it was like a $5 or $5.50 stock price or ETF price, right? And the yield was about 22%. 21 or 22%. And it was like, wow. So I started off buying 10. I'm like, okay, I'll buy 10 of these, spend $50 and wait a month and get paid my dollar, right? I got paid $1. But then you buy it and you see that it works. So what do? You buy more, right? So yeah, for a few years, I was really big into split because you got DFN, FTN, GDV, FFN, and there's a lot. And there was ones where he even advised, don't buy them. He's like, these ones are too risky. There's a good chance in a down market they won't pay. And he honestly didn't recommend them. But of course, I bought them, right? Like FFN, I think was one of them. Probably didn't pay for about a year, right? So now I'm currently not in splits anymore, only because Harvest and Hamilton and Evolve have come out with such good covered call ETFs that they're offering the same or higher yields. And there's not the risk of them not paying, right? The same. But I know there are people who are doing really well with splits because right now, a lot of them have all of a sudden given out not free shares, but they typically don't increase their distributions, but they'll give you like one share for every 10 that you own or something, So people are getting bonuses right now. It's kind of like when companies buy back their own shares. that increases
Yeah.
the stock value. So that
Yep.
instead of them increasing how much they pay per month, they're giving you extra shares. So you're
Yeah.
you're going to get more per month.
I think this hits on one of the important topics that if you're new watching this or you're just trying to figure out investing is, you know, they talk about the all equity approach or they talk about the 70-30 or 60-40. And what does all that mean? Well, you right now are essentially, you're just sort of helping describe that, which is this fund will provide you with some guaranteed income in certain market conditions. And some will refer to some of these things like annuities. They're going to pay you, you put money in, it'll consistently pay you the same thing. However, you don't want to put all of your money into that. I think that's the key. That's that
Yeah.
diversification idea. A lot of people are probably scratching their heads and saying, but Paul, you're majorly diversified right now because in your last video, you went over all the positions that you have. Again, it's investor dependent. Would you agree with that? Like, why do you have so many versus, say, someone else who does it?
Yeah, I mean, sure, it's investor dependent because everybody has, I guess, a different capacity for what they want to manage or how many funds they want to look at on a monthly basis or whatever. Um, there is a guy, and I can't remember his name now. He used to have a really popular YouTube channel. He retired at like 33. He was a single guy. He moved from like Detroit to Florida. He was in the car business. He saved up 100 grand. That's it, $100,000. Moved to like Thailand. But he kept a YouTube channel going, and he would only buy dividend growth stocks, right? And he called them the goose that laid the golden eggs. And at one point, he had like 100, right? He had like 100 of them because, as long as they were doing what they were supposed to do, he was okay having that many positions. And a lot of people would be like, "Are you crazy to have 100?" Even myself included. I think I'm about 40 right now.
Right.
And I try from time to time to like trim, sell some off, but there's so many new ones coming out that are, in my opinion, are really good. I end up selling one and buying two or three more. So I don't know. I can't do it. Yeah, I can't do it.
I get questions like that frequently, and I don't think I have a ton of positions, but I do have a fair number, and I get the overlap question. And I think that as a new investor, I wouldn't call myself a beginner anymore. I think I'm more like a novice now. But you have to try some of these things. You can read and learn all you want, but I find for me, like I had a split share, and then I realized, like, oh, this for me right now, this doesn't really work. Later on, it might.
Yeah.
So I got rid of them, but at least I tried. QQQY was another one. Like, oh, what's this all about? And then I
Is
learned
that the
more
one from
about,
Defiance?
yeah, and then I learned more about synthetic versus actually
Yeah.
holding shares, which I think is important. But these things come with time. Nobody's going to drop a book in front of you. You got to learn it on your own kind of thing. So on Blossom Social, the growth versus income debate is nonstop. Why do you
Yeah.
think so many investors, especially Canadians, are gravitating towards income first?
It's a good question. I don't know if it's the dopamine rush. I think is that what Ari calls it, like the dopamine hit when you get your monthly income coming in, or if it just is easier, like maybe it's just an easier way of managing your money, like, not easier in that growth doesn't work, but maybe people just don't understand the growth philosophy of selling shares to create your own distribution. Like to me, that's almost like more management. You have to manage it yourself. You have to know how much you can trim, and if you follow the dividend guy from Montreal, Mike, he talks about having a cash wedge. So you got to have your growth funds, but then you also have to have like $50,000 in ladder GICs for when the market crashes. And for some people, it might be just too complicated as opposed to just buying covered call ETFs and collecting the distributions and reinvesting.
Yeah, so that's a great point. I recently had a big expense emergency fund. So let's touch on that because that's what happened to us. It's important. You got to have some money set aside for whatever life will throw at you. And in our case, the furnace and the air conditioner went, had to replace them both, ate up
Jeez.
every dollar that we had. But because of all of this learning that I had done, guess what? We had an emergency fund. Now it was liquid and it was cash. But then I got thinking, well, wait a minute, like this money's going to sit around. We don't know when we're going to need it. So will
Yep.
the covered calls work? So this time around, what I've done, if you watch some of my videos, is I'm plowing money into the TFSA.
Hmm.
It's a separate one set aside from Quest Trade. And that way it's just by itself that I can see it. I've titled it Emergency Fund. And I'm putting 50% of it into VFV and 50% into covered calls. And the idea here is to see what kind of growth we get from it, and then see what's going to happen when the market changes and if we need that money. So, the idea of having an emergency fund is to have that cash ready to go now. I'm not going to prescribe to that. We'll see what happens. Might be a bad choice. You never know. What do you think?
No, I'm with you on that one. I personally don't even have an emergency fund, although I'm not recommending that to anybody, especially younger people. I had what I called a vacation fund, and it was, money set aside for vacations. But if there was an emergency, I could also pull from it, right? And every time the market dipped, I'd be like, I need like $1,000 to buy some more ETFs. So I just would take from my emergency fund. And now I have no emergency fund left. But I was just saying while we were disconnected, I wouldn't recommend that, like, especially for a lot of younger people or people who are in different situations. You know what I mean? I'm lucky I have a wife who has 3 jobs and she tends to squirrel away cash. So if we ever had a really bad emergency, plus we have a line of credit, we have credit cards, I think we could make do if we had to. But
Yeah.
for a lot of people, emergency fund is probably, one of the key things to have.
Which is also a key concept of investing, which you already touched on, is that the ladder GIC effect, or having some sort of cash in the event that the market changes. That's one of those concepts. So I'm testing that a little bit, and maybe I'm making the wrong choice. And we're definitely coming to a market change right now. It's still growing, so to me it feels okay. But yeah, I know that when I needed that cash, it was ready to go. So do you think that's the sort of notion is psychological? When you mentioned it already, so people like seeing cash in their accounts, and if it's technically just their own capital coming back, then is that okay?
I actually have a couple of friends who, one of them, he won't keep less than like $10,000 in his bank account. And to me, it's like, but that's $10,000 that you could be making money on, right? And his fiance, apparently, she won't keep less than like $25,000 in her account. And I'm like pulling well, I don't have any hair left to pull out, but you know what I mean? Like, what a waste to have $25,000 that could be, earning some good, some good income.
But to echo what you just said, though, for someone listening here, if you're young and even up to, I would even say argue up to your 40s, you still have lots of time. Like a lot of people think, I thought like, oh, I'm going to retire at 60, which is about 8 years. And I thought, that's it. There's no more. But that's not the truth, because you're not necessarily going to draw down on all that money. You can keep investing it past that point. So looking at your time horizon is important. For me and Paul right now, this kind of makes sense because there's not a lot of time left. But for everybody else, like, have that emergency fund. Don't plan based on what you see Paul and I doing. Make some decisions based on your personal circumstance, time horizons, risk tolerance, and things of those nature. So, Paul, we've learned a lot from each other in a pretty short period of time. I'm actually enjoying this conversation. So, what's one thing that you've learned from growth focused investors?
Well, growth, like if you look at guys like Mo, and I know there's a few others on Blossom that I can't remember their names, but they're a similar situation to Mo where they just invest into XEQT. It's obviously a very simple to implement investment strategy. You know what I mean? Where they just pick the one growth ETF, put money into it regularly, and let it do its thing. And like I was saying, my son is doing something similar. And every time he opens up his portfolio, it seems like XEQT has gone up and it never goes down. So he loves it, right? He really likes that. Although it means every time you buy it, it's more expensive, right? He's waiting to dollar cost average down, but it never seems to happen. So yeah, I think but then you get other people who are more into, say, trying to pick the next stock, right? The next hot stock, or those kind of growth like tech stocks. And, so that can be very, what I think happens, Darren, to be honest with you, is say you and I and a couple other guys work together and some of us are killing it on Palantir. So we finally convince our friend to buy it at $140 a share. He jumps in and he knows we've already made like 100%. But then next week, something happens in the political news, economy, whatever, and it drops from 140 down to $70. What happens to him? He panics, right? He panics, he sells, he just lost 50% of his investment, right? And then a few months later, Palantir's back up at 150, right? So the growth investors will say to guys like us, if you had just held Palantir, you would have made 400%. But a lot of people buy it high, sell it low, buy it back again. You know what I mean? Because they
I
panic
do.
sell.
Yep.
I don't have to worry about panic selling. I never panic sell, you know. I did once with DFN and it was a big mistake. And our Facebook group convinced me that DFN was done. And I sold and I lost some money and it went from $3 back up to 6. I should have bought more.
Yeah, another key concept though is, you got to ride these ups and downs. I have a few videos I've done on it after I learned like, if you were to sell at the bottom, you're only shooting yourself in the foot. So, yeah, it's a key concept that people need to get. Don't turn the news on and find out that Trump's implementing new tariffs and you
Yeah.
decide to sell something that's craziness in my opinion. I think that goes to the idea like buy and hold. Although some would argue in some people's portfolios they're not doing that because I've heard that said, but I think all in all over the long term you just want to stay in the markets. I asked you about growth investors. So now what's something that I or others like me could learn from cover call investors?
I think, if you watch some of Adriano's videos, he goes through a lot of the different things that being a covered call investor, you may not outperform the market, but you sleep well at night. We tend to worry less because we're not trying to buy low and sell high. We're not worried about timing the market. If we see our portfolios drop, most of us passive income investors actually get excited, right? When the market, we're all on Blossom, we're all talking about when is the next correction coming because we want to buy more. And it's funny, we like to see our portfolios going up and being at an all-time high, but then we look at the cost of our ETFs and we don't want to buy them because we're up too much. I've got some that I'm up like 70%, and I'm debating, do I trim now? Or, do I just hold it and see what happens? Uh, yeah, there's definitely a lot of benefits to being a covered call ETF investor. I find it's very simple to do. Once you learn a little bit about it and you understand how they work, it's such a growing industry. You have Harvest will put out a product and it's fantastic. So then Evolve has to come out with something that's a little bit better, and then now HHIS or Harvest has to compete with what Evolve did. So I honestly think they're really working hard for our business, and that's to our benefit.
I was thinking about this because I figured we'd talk about it, but I kind of equate it to car dealerships. You know, you,
Yeah,
how many, because there's so many of them out there now, they're all competing for your business, which is a good
that's
thing
right.
for the consumer. Now, of course, some of them have higher fees than others, but when we talk about learning, don't just do. I can't say this enough, and I'm sure you'll echo this, Paul. I know you say it. We're not financial advisors, guys. We're
That's
just,
right.
two real Canadians who happen to be the same age, and we're sharing our stories with you. But if you've listened to what we said in this podcast, we are telling you that there is a lot of learning that has to go on. So the
Yeah,
first time you find out about a fund like HHIS, that sounds cool, I should buy it. I would suggest open up your computer, type in HHIS and start reading about it. What is it? And if you have
yeah.
questions, take them to Paul or me. You can always message us in the background or go on Blossom. Type in the search bar. You're going to find out more about these if you take the time to learn from them.
Start
Any
small.
last?
I always
Yeah,
tell people to start small. Like if you want to invest in HHIS and let's say you want to put $50,000 in it because you say, hey, look, Paul's got $50,000 in it. Start with one. Buy a
yeah.
$1,000 worth, right? Wait a few weeks, see how the share price goes up and down, watch it and see what it does. When you become more comfortable with it, put in another 1,000 and just build up your positions over time. You don't have to rush into it. It's not something that you have to do overnight. Yeah,
Very good advice. That's so true. And I can echo that as well. So, Paul,
yeah,
I think that we should keep this going. What do you say?
definitely.
Maybe every month we'll
Yep,
revisit and see how things are going. And maybe what we can do is start building in a little bit more about what positions we have, why we hold them, and let listeners make the decisions for themselves coming from two guys that, are just regular guys who have jobs in outside of the financial industry. So, thanks, Paul, for joining me. Any final
thank
thoughts?
you. No, but I like that idea. I'm looking forward to getting back online with you and chatting again.
All right, Paul, thanks for being so open about your journey. This is the kind of conversation that's missing in investing in Canada as a whole. Don't forget, guys, to check out Blossom Social. It's a really cool place to go have some
I love your
conversations.
mic. I got to get one of those.
Real people testing real strategies here.